China's economy is suffering from the opposite, deflation.
China's economy losing further momentum.
Okay, they are out. Not good, all right.
Persistent deflation for a third straight month.
With a mounting debt crisis as investors ramp up calls for fiscal stimulus to boost the economy.
Taxation affects the world.
What if I told you the world's second largest economy is in deep trouble and might not get better anytime soon? Yes, we're talking about China's economy and the crisis it's facing. From a massive stock market sell-off to deflation and struggling domestic demand. Let's dive into the data, examine the impact on local industries, and explore what the Chinese government is or isn't doing to fix it. China, the world's second largest economy, is facing significant challenges while U.S. stocks are hitting record highs. In contrast, Chinese stocks have plummeted by over $6 trillion since their peak in 2021, marking the worst performance among major markets this year. This downturn has led Tokyo to surpass Shanghai as Asia's largest stock market. The crisis has also hit China's asset management industry hard, with the highest number of mutual fund closures in 5 years. Comparing China's CSI 300 index to the global MSCI World Index since mid-2023 reveals a sharp decline for China's largest companies. A startling statistic shows that the Hang Seng's price-to-earnings ratio is now lower than the Nasdaq's price-to-book ratio, highlighting the severity of the situation. China faces several key challenges that suggest a tough road ahead. One major issue is deflationary pressures stemming from a slow post-COVID economic recovery. Unlike the US, China has struggled to revive domestic demand for goods and services after strict lockdowns. This has led to widespread deflation, with consumer prices experiencing their longest decline since 2009. Bloomberg reports indicate that China's overall prices have seen their longest drop since 1999, driven by declining nominal and real GDP growth. Consumer spending remains low, contributing to a prolonged decline in factory gate prices set by manufacturers before additional costs are factored in. These prices have been falling for more than a year due to reduced commodity prices and weak local and international demand. Chinese exports, a crucial pillar of the economy, dropped by 4.6% in 2023, the first annual decrease since 2016. Export values have also declined, making Chinese goods cheaper for foreign buyers. Additionally, food prices in China have fallen continuously for 6 months. Overall, pervasive deflation in China's economy raises doubts about whether significant government stimulus will be implemented soon. Yep, you heard that right. While many countries are raising interest rates to cool down their economies, China is taking a different approach. The Chinese central bank has promised to adjust macroeconomic policies to support the economy and boost prices. However, observers are still waiting for substantial action from the CCP. The core issue in China is persistently weak economic demand, which is driving down prices. Despite repeated talks of boosting domestic consumption, effective measures have been lacking. Raymond Young, chief economist for Greater China at ANZ, warned that bold action is needed to break the deflationary cycle, or else China risks falling into a negative economic spiral, similar to Japan's experience in the 1990s. Economists are urging the Chinese government to intervene, with many expecting interest rate cuts as a form of support. However, contrary to expectations, the People's Bank of China decided not to lower rates on its one-year policy loans, leaving analysts puzzled. Addressing deflation remains a critical concern that requires prompt government action. Now, turning to Beijing's latest economic data, the outlook is concerning. China's GDP grew by 5.2% in 2023, an improvement from 3% in 2022, but excluding pandemic years, this growth rate is the lowest since the 1990 recession. Quarterly GDP growth slowed to 1% from a revised 1.5% in the previous quarter. December indicators alongside GDP data reveal worrying signs, particularly in the real estate sector. A notable shift in government policy from supporting large property developers to allowing some to fail has led to the collapse of several private developers. This has raised serious questions about the future of China's property market and its broader economic health. The challenges in China's economy, especially in the property sector, continue to pose significant risks amid ongoing economic adjustments and policy uncertainties. China's second-largest property giant, Evergrande, has filed for bankruptcy in the U.S., adding to recent concerns about China's housing market. In December, new home prices in China dropped at their fastest rate in almost 9 years, marking the 6th consecutive month of decline. This downturn reflects a lack of buyer interest and financial strain, with property sales falling by 8.5% for the year, and new construction starts plunging by a steep 20.4%. These challenges have led to delays in construction as developers struggle with financial issues, exacerbating deflationary pressures. Despite these troubling indicators, a Chinese premier speaking at the World Economic Forum expressed confidence in achieving around 5% economic growth for 2023, without resorting to extensive stimulus measures. The latest economic data from China also included the reemergence of the country's youth unemployment rate. Last year, the rate peaked at 21.3%, meaning 1 in 5 young people aged 16 to 24 were without a job. This statistic gained significant attention abroad, prompting scrutiny. Strangely, in August, the Chinese government suddenly stopped reporting this data, citing plans to review its measurement methods. Analysts view this move as part of a broader trend of opacity regarding China's economic health.
Now, the job situation in China is looking grim. One forecaster sees the unemployment rate almost tripling last year's number.
Youth unemployment is particularly concerning because young people are often highly educated and eager to work. However, due to the economic slowdown, businesses are hesitant to hire new talent. Instead, they prefer to rely on experienced workers amidst financial difficulties. Another issue is the mismatch between the increasing number of college graduates and the available jobs, primarily in the service sector, which historically employs many young Chinese. China's policy of expanding university enrollment has led to a rise in graduates from 2.2 million in 1990 to 3.83 million in 2021. However, job opportunities in the service sector have not kept pace, exacerbated by government policies and the lingering effects of the pandemic. The Chinese government's response to the youth unemployment crisis has focused on several measures. They've increased recruitment in the civil service and expanded postgraduate enrollment. Additionally, they've invested approximately $1.8 trillion in infrastructure projects in 2023 to create job opportunities. However, critics argue that these efforts haven't addressed the core issues. Investors are advised to monitor developments closely to gauge future prospects for Chinese stocks. What are your thoughts on the future of Chinese stocks? Be sure to share them below. And if you enjoyed the video, give it a like and subscribe for more.